Hello, everyone. My name is Sylvan, and I work for Starboard. So today I want to do a presentation and introduce a solution that's in the making that could potentially help you turn your locked initial pledge to liquid asset. So let's dive right in. So I just want to start my presentation with a quick overview of Filecoin's current DeFi landscape. So as you see, this is the DeFi leaderboard that we've made, and then it's serving as like a way for people to understand how quickly are DeFi protocols growing, and then how quickly are they taking over market shares. And then you can see that we have seen I think you can see that it's starting to taking the exponential shape. It's growing really fast. And then earlier this morning, I checked the total net deposit is almost 10 million now. So we are beginning to see this exponential growth for Filecoin's DeFi landscape. But also, if you just take a look at the individual growth for specific protocols, they are kind of still pretty linear. So we are beginning to see more DeFi projects coming into Filecoin to work on liquid staking, work on SP lending, but there are still many challenges to existing DeFi protocols. Yeah, as you can see that the top three are all in this 2 million range, and then you have a bunch of 500K to 1 million range protocols. So we've also talked to many developers, talked to many storage providers, trying to figure out what are the challenges that have been posed to Filecoin's DeFi. So the first challenge is definitely fundraising. Right now, most Filecoin's DeFi projects, they're still working on new Filecoin users, meaning people who have never invested money in Filecoin. And that requires them to first convince new investors about Filecoin, right? So what is Filecoin? Why does it have a huge potential? Why you should invest your money in Filecoin for that future upside. And the second thing is that Filecoin mining is very complicated. So it involves, submitting on-chain proofs. It also involves off-chain, and then mining operations. How do you manage your risk? How do you manage your machines? And then how do you operate your SP business? So you also kind of need to convince your investors to trust the mining selection process, right? Because this is there's the off-chain component. That means that every miner is a bit different, I guess, right? And then also the earnings are dynamic if they rely mostly on block rewards, right? Because how well you are maintaining your proofs, how well you are operating your SP business could contribute to the earnings of the entire SP business, and then how that's gonna get distributed to your end investors. And second thing is the challenges to scalability. So we have spoken to a few storage providers, and also storage providers who are converting their business from mining to DeFi, and then they're saying that, okay, when I onboard a new investor, usually I need to set up a new mining node for them, right? Otherwise, all the accounting gets a bit tricky. If I include them into another sector, that has already been onboarded to the network and is already earning the block rewards at full speed, how do I really split up the shares, right? So how much of that should go to the original investor? How much of that should go to the new investor? So that's something that's very hard to determine, and that's why most storage providers, when they collaborate with DeFi project on board new investors, they tend to, or they prefer to set up new mining nodes. But it takes time to set them up. It takes time to seal sectors. It also takes time to earn block reward at full speed. And also, there's also this chicken and egg problem for all the DeFi protocols. It's like when you get some investors to commit, their funds come in, but it's always unutilized, right? Because it takes time for for a DeFi project to go to a storage provider and say, hey, I have 100K Filecoin. Do you want to take it? If you want to take it, you need to agree to all these terms. And then after they took it, they say, oh, great, I'm tapping into new liquidity. I want more. And then you need to go back to your investors and say, hey, all of the funds are being consumed right now. Do you want to put in more? And also, by the way, because there's no protocol balance, you cannot redeem, right? Because all of the funds have been put in use. Of course, I can give you like a liquid staking token, and you can sell it in the open market, right? But that's another problem, right? It's like who are going to provide liquidity to all these LSD tokens? So then there is always usually either unutilized capital staying in the pool, or there will be like insufficient liquidity for redemption. And the final thing is that for some of the DeFi projects that requires interest payment, that requires like mining sharing, you kind of need to, like for storage providers, they kind of need to manage the interest and principal payments or reward sharing in an operational way, right? I need to keep track. Oh, when is my next payment due? I need to keep track of that. What's going to happen if I miss one payment? Are they going to liquidate or terminate my nodes? Is that going to cost me anything, right? So I still need to, if I are a storage provider and I'm taking money from the DeFi protocol, I still need to keep those in mind. And then in the case of like termination or slashing, it's not just the storage provider that are taking like a negative impact. The negative impact also will go to DeFi projects because like think about if your earnings is based on block rewards and then your sector goes into faults, you're not earning that block rewards and suddenly your earnings is dropping, right? What if slashing happens? What if termination happens? And then will that eat into your principals? Right, who knows, right? So that's something that's very challenging to the existing Filecoin DeFi projects. So what I want to do is I want to take a step back. I want to take a closer look at the Filecoin's economic model and understand which part really requires the liquidity. And then I found this. It's the initial pledge, right? So all this initial pledge is being staked to the Filecoin network. It's like you're putting money into a big safe that's created by Filecoin, and your money is just there. In return, yes, you operate your machines, you get like block rewards, but that's more like a proof of work process. But that money has no liquidity, right? It is safe money because it's being held by the network. So you know that the money is always going to be there. But it's not doing anything. You cannot lever up your mining business, or you cannot use the money that's already there to help you obtain liquidity for liquidity management. And based on our record, there's right now close to 170 million Filecoin that's being locked by the protocol. Of course, some of that is lock rewards, but the majority of that are initial pledges. And that's over $500 million in value, sitting there doing nothing. So here's our hypothesis. We can potentially create something that provides liquidity for locked field because we know that it's safe, it's there. On one day, it will come back. It will become liquid. And then, for that, we can probably create something that's standardized. Meaning that if you're a small miner, you have a big miner. If you're a new miner, if you're like a miner that has been in this business for so long, it doesn't really matter, right? So meaning that this is a standardized offering where for investor, they don't need to think about how do I choose storage providers or choose my mining partner. And for miners, they don't need to have like a track record, or they don't need to have like a threshold of a size to be able to borrow money. And there we create something that's more standardized. And that could potentially, have a more like a deeper liquidity in the open market. And with that, potentially we can achieve faster path to network effect, right? You can have more people coming in, contributing to one single token or one single medium of a liquidity that's contributing to storage providers and also contributing to investors. And that can give you like network effect. And finally, we want something that's a simple experience, and then also like a simple decision-making process, right? I as an investor, I don't need to calculate, oh, what is the dynamic yield? What is the inflation or like deflation schedule of the Filecoin token? How is the Filecoin token supply gonna change, right? I want to know how much I'm earning. So for initial pledge, like 100 FIL in initial pledge, is 100 FIL in initial pledge. You know that this is secure cash flow that's going to be returned to you on the expiration day or the termination day, right? So that's something that's very secure. That's something that's very certain. And that's something that could potentially offer an alternative to like rewards or like earnings that are based on block rewards. So here I introduced you the Filecoin Perpetual Pledge Swap. So this the meaning of like Filecoin Perpetual Pledge Swap, meaning that we're swapping pledge perpetually with an investor or with the open market. So it has like three main features. The first is that we introduce a tokenization process of initial pledge. So for all the initial pledges, first of all, we have this small note that's considered safe, and then my colleague Ben Hao will talk about what do we mean by safe pledge shortly. So for every locked FIL in initial pledge that's considered safe, we can mint a P-FIL or pledge FIL token for the storage provider or for a pre-designated address that's designated by the storage provider. And then for the storage provider, they can sell the P-FIL in the open market. It is a standardized offering. It's in exchange for a future certain cash flow, right? So it's less risky than sharing of like block rewards, and then you can sell it in the open market to obtain liquidity. And also because this token is based on a certain future liquidity or certain future cash flow, the yield or the interest rate to this is supposedly lower than that of a mining sharing or like a lending scheme that's based on future block rewards. And as the Perpetual Pledge Swap protocol recovers more liquid FIL in the form of like block rewards, for example, the storage provider can mint and sell more P-FIL to fulfill their liquidity needs. So for investors, they can earn yields. What they do is that they just buy P-FIL and hold them. And that's the way of them providing liquidity in the funding market, and they can earn dividends on that. Okay, you might have this question: where does the dividend come from, and how exactly does the yield work? So let me just break down the process for you. So the first process is for a storage provider to pledge a mining actor to a smart contract or to our protocol. In exchange, the smart contract will give the storage provider the allowance to mint P-FIL, to mint P-FIL tokens. And the storage provider can mint P-FIL one-to-one to all the initial pledge or locked FIL in their mining actor. So one-to-one. And when they want to obtain liquidity, they can just I mint P-FIL, and then I take that P-FIL to the open market, I sell P-FIL for FIL, and that's turning their locked initial pledge into liquid asset, right? Into liquid FIL, and they can use the liquid FIL to do other things. And for investor or P-FIL holders, they contribute to liquidity for P-FIL by buying and holding P-FIL, and that you create a trading pair between P-FIL and FIL, and that's how the liquidity is being circulated between investors or P-FIL holders and storage providers. Okay, next step is recovering liquid FIL. So the smart contract will receive release locked FIL from the Filecoin network, which is block rewards, release initial pledges, and then the smart contract will buy back P-FIL with the field that they receive from the open market. Okay, here's where the dividend comes from. So you know that we mint, the smart contract mint P field at 1-to-1 for all locked field with a storage provider. That locked field will become liquid at some point. So say if I mint 100 P field for one storage provider in exchange of 100 field at a future date, it comes back, and then I use that 100 field to buy back 100 P field. Of course, there will be a discount of P field in the open market, right? Because P field represent locked field, which is not liquid, and field is field, right? It's liquid field. So there will be a discount. So meaning that P field and field will always be trading less than 1-to-1 in the open market. So for the smart contract, the smart contract can just buy back 100 P field with less than 100 field. Say I buy it back at like 90 field, right? Then what I did, what the smart contract does is that it kept 10 field as the profit. And that's essentially the interest income of the smart contract. And we distribute that back to P field holders or investors based on the duration that they hold P field. So this is how the yield and how the earnings come from for the entire perpetual patch swap solution. Yep, have a question?
So just to understand, so when let's say sector expires,
Yes.
the bill that would be freed up
Yep.
from that expiry would go back and buy P off the market.
Yes.
It would almost be an exchange, right? So
So there could be many exchanges. So it could be a DEX, right? A P field and field DEX pool. It could also be that P field is like being traded in a centralized exchange. Like, so we don't really care, but as long as there's this market for P field, it could also be a market maker who is offering these services. Yeah.
but forget the exchange.
Yep.
Exchange is a loaded term. Sorry, but so if a sector expires, the fill resulting from that expiry would go back and buy back P fill from the open market.
Yes.
Basically. Okay,
Yes.
okay.
But they will only buy back a targeted amount of P field. Say if I so the smart contract will create like an agent contract for every mining node that's being pledged to them, or like aka change owner address, right? And then it will calculate how many P fields has these particular agent contract minted. So that will be like a state in that contract. And then when field becomes liquid, the contract will use the liquid field to buy back the X amount, which is like how much P field has been minted in the agent contract. It will only buy back that amount.
Gotcha.
And then it will leave a portion as like interest income or like dividends. And then that portion will get distributed back to investors. Great.
I have another question.
Yeah, sure.
Isn't there some risk here that like speculators can move the price of P fill higher than the 1-to-1 ratio, and then the storage providers needs to buy back that at like higher prices than what they sold?
First of all, the pledge happens perpetually. So after the storage provider pledged the mining actor to smart contract, the swap happens, and it happens perpetually. And the storage provider does not need to do anything after that. They just need to sell their, I mean, they could also hold on to their people, but why would they do that? Or maybe they can become like PFO holders and earn the dividends, right? Who knows? But usually what will happen is that the storage provider will get back PFO, and then they will sell it in open market, and they get liquid fill, and that's it. Everything, they don't need to do anything else. They only need to do one thing, which is that when the contract recovers sufficient field to recover all the P field that has been minted, the storage provider might be able to like withdraw additional fund. So we talk about, I think Ben Hall will talk about the definition of safe pledge later. But here we actually say that we mint a P field for every locked field in the initial pledge that's considered safe. So what about the safe portion, right? The unsafe portion. If I am a storage provider that's like really good at what I do, I should have no slashes, no terminations. I'm earning all the block rewards, and then that means that I will be able to withdraw additional money from the storage, from the mining agent contract. Yeah, so that's the only thing that the storage provider needs to do. they don't need to repay interest. They don't need to pay back the principals because the swap happens already. Yes.
So at the beginning, you said there was 500 million available in the pledged.
Yes.
Of that number, how much is borrowed? Because I'm presuming you can't do this on a miner that you don't actually fully own, i.e. a Dharma miner.
Can you clarify a little bit of what?
Of that 500 million,
yes.
a lot of that would have been borrowed from Anchorage, Dharma, CoinList, and used in a miner. The owner actor is controlled by the actual lender.
The actual lender can use that to fulfill their liquidity management as well.
Okay, so the SP can't use it. The actual lender uses
Whoever
it.
owns the owner address. It could also be a scheme where the lender and the storage provider reach an agreement. Say, okay, we're going to lever up our mining business, or we're going to use this miner actor as a leverage or as a collateral to obtain additional liquid fuel for our liquidity management purposes. For example, if someone needs to redeem their shares at Dharma or Anchorage or CoinList, and if all the token has been utilized and being staked to mine, then I have no money to essentially to fulfill their liquidity needs.
Okay, I love this product.
Yeah.
But really, it's an asset-backed loan
It
with no risk if the termination the initial pledged is more than the termination fee of which you can hit terminate, right? So there's no risk if there's enough there.
Yes, trust us. We are the research expert on this topic. I think let's have Ben Hao talk about this part, the definition of safe pledge.
Thanks, Sylvan. So you asked about what the safe pledge is, right? And basically, because we have been calculating all these costs on our dashboard for years already. So I have to give you a bit of a rundown of the basic sector penalties and termination penalties. So imagine you onboard a sector and then you terminate it right now. So you only pay the pure termination penalty, which is in blue here. But if, let's say your sector incurs, it goes offline for, let's say, 42 consecutive days, then you also incur sector penalties plus the termination penalty. So when we actually tabulate all this cost together, actually we find that about less than 20% of the initial pledge can be potentially removed. So that is how we kind of tabulate the safe pledge.
I'll just add a bit on that. We can even go a bit lower, like say 70%. That will give us really a lot of buffer to this calculation. But that's mainly because there are like two parts of initial pledge. One is called storage pledge. The other is called consensus pledge. So storage pledge is used for providing this assurance, like in the case of false, in the case of terminations, how much of that is going to go away. And then consensus is more for the protocol governance, right? So how much of the target circulating supply do we want to lock within that particular mining action? Yeah.
So, I feel like we shouldn't be using the word leverage in this product because it's not leverage, is it? It's an asset-backed loan, which is fill on fill, and you have all the asset, you can terminate in that safe area. So it's not really leverage, is it? So
why is it not leverage? Okay, think about it. Let's do an example. Like you have 100 fill.
All right.
Yeah,
Finance man says it is leverage. Okay.
Yeah. Cool.
So basically, asset-backed loan at 70%.
I'm sorry.
Asset-backed loan at 70%.
Loan to value 70%. Basically, that's the case.
So the biggest problem here is the buy liquidity.
Yep.
P, fill, and fill. That's
Yep.
the biggest hurdle to get over.
That is not the biggest hurdle because you will already have liquid field. You just need to find a way for example, traders, market makers, arbitrageurs, because there is a running P-field and field market. And then now you have field coming into this protocol, and the protocol wants to buy back P-field. Someone is going to arbitrage on that. And then they're going to move back the P-field from the open market back to the protocol in exchange for field. And you have a question about, well, some people just like move it up to like over 1.1. So the over 1 to 1. So the protocol is making loss, right? So in that case, all the SPs will just mint thousands and millions of P-field to sell in the market, because that's like arbitrage opportunity for them as well. You are giving me more field than my locked field. Like I have 100 field in lock that's coming back in 1 year's time, and then you want to exchange that for 101 field at the moment, then I'll definitely do that.
Okay, but in a scenario where there are no SPs, that say every SP has like tried to arbitrage away this opportunity, like get more P fill.
Yep.
What then? Someone has to like take that loss in a certain like spiral.
Where does the loss come from?
So if the investors then selling the P-fill token would then, maybe I'm just
so what you're saying is that all these investors are trying to mint more P-fill and dumping that in the market, and suddenly all the investors get scared. They want to sell that P-fill in the market, and then P-fill is going to right?
Yeah.
Okay, at the moment, then I'll definitely do that.
Okay, but in a scenario where there are no SPs, that say every SP has like tried to arbitrage away this opportunity, like get more P-fill. What then? Someone has to like take that loss in a certain like spiral.
Where does the loss come from?
So if the investors then selling the P-fill token would then, maybe I'm just.
So what you're saying is that all these investors are trying to mint more P-field and dumping that in the market, and suddenly all the investors get scared. They want to sell that P-field in the market, and then P-field is going to right?
Yeah.
Okay, we have. I'm sorry.
The yield on P-fill would be high, right?
Yes, and that's let's go to the next slide for this. Yep. So I think.
I think a lot of people are very excited to see math equations. But I mean, the basic principle is quite simple, right? It starts from some kind of conservation. So the conservation here is that, you know, the rate at which the circulating supply of token must always be balanced by the rate that you are locking fill in the protocol, minus the rate at which the pledges expire. So once you have this basic conservation principle in place, then you can kind of write down an equation that specifies the wealth of the holder in time. And basically, it's inversely proportional to the token price, proportional to the holder's fraction of circulating supply, and also to the rate at which the protocol receives the pledge from the network. So if you solve this equation, just trust me, you get an equation that has a so-called implied interest rate. So you can kind of recast your returns as an effective interest rate. And then the question is, right, how do we know that this interest rate will be robust? Well, because there's some inbuilt mathematical properties of this implied interest rate. So for example, if your token price drops, right, then your implied interest rate increases and it becomes more attractive to investors. And vice versa. If the token prices rises, then the interest rate decreases and it becomes more attractive to SPs. So
yeah, so just put put it in a more intuitive or straightforward terms, is that if the token price drops too much, because you know in the future there will be secure and certain cash flow coming back, so that creates a natural buy power of the P field. Right? Think of a world where P field just like goes to zero. That just means that no one is buying P field, and all the storage providers are minting P field. Right? There won't be a market for P field. All the P field price will just be zero. However, because when the perpetual swap happens, it already kind of implied a future buy pressure from the protocol on P field. So that's like a fundamental thing. So even if the P fuel price is zero, right, at some point, all the liquid fuel comes back to the mining actor, and they will start to buy back P fuel, and then the price of P fuel will go up. So in some way, this mechanism or this design has like a self-healing feature. Like if the price goes too low, right, there will be buy pressure, like natural buy pressure from the initial pledge. And then of course, if there is a natural buy pressure, people won't regard this as like value at zero. Yeah. So does that answer your question, Orion?
As a complete side note, does this mean if like all block go fits Phil, that will be the largest DeFi economy?
At least we'll have 500 million TVL.
Yeah, which is like,
And
like DeFi Llama would count that as TVL. So like, I don't know, top 5 or something? Like, you gotta be up there.
yeah, I mean, but I think the most the most important thing here is like we're trying to create a standardized offering here, because right now I think like a lot of smaller storage providers, some storage providers are new to the business. Very hard for them to get like financing, because right now the liquidity is kind of scarce. Like people don't really know how should I, like if I have $1 million fuel, like how should I choose my storage provider who I partner with for this mining sharing. Exactly. They have this. They need to do this. They have this mental burden, right, of like selecting the DeFi protocol and then trusting the miner selection process behind the DeFi protocol. But here, it doesn't really matter if you are a small miner, you have a big miner, you're a new miner, or like a miner has been there for years. It's all the same. If you can prove that you have initial pledge, and then we calculate the safe pledge for you, you can get liquidity. And that's a great way for people to ramp up their mining business as well.
So the next step after this, say you launch this, the next step could be, oh, you've won a block today, so now I know your revenue for the next 6 months, take off the bit at the top. You could use that as well.
So I think what you're talking about is like how would we treat block rewards coming into the mining sector, right?
Yeah, I suppose that's harder because you could just terminate, or you could, so that's harder just to do that. I think you don't, right?
I don't what?
Yeah. It's fine. Yeah. It's
like trying to securitize the income stream.
Yeah, so I think that's essentially the same, because here we are keeping track of two parameters. Two variables. One variable is how much P field has been minted by a certain agent contract. The other is like how much liquid fuel has been recovered by the protocol. So let's say that the first one is X, the other one is Y. What we are measuring here is X minus Y. So the total amount of P field minted minus how much liquid fuel has been recovered by the agent contract. And that difference cannot go beyond the safe pledge ratio, or like a safe pledge amount. So that's your credit line. And so think about it, if block rewards comes in as liquid fuel, what you can do, like if you really need that liquidity, what you can do is just to mint more P fuel and then sell it. And then you can kind of cash out your block rewards. It is, slightly discounted because of the P fuel price going to be below fuel. But you can also choose to wait until the date where the initial pledge recovers. But mathematically, it's all the same because the discount rate is the same.
Question about how is this affected by gas fees, considering when you're collecting, when the smart contract's collecting is swapping the fill back for the P, swapping the fee fill you do that as much as possible, as quickly as possible, or do you do it in micro amounts over a certain amount of time?
So what we have thought about it is like we introduce an auction mechanism so that we auction all the fuel that has been recovered by the agent contract in a single auction contract. And then people can just like, place their bids and then take it out. So we can do it on FEM. We can also do like it on a scaling solution for FEM if gas fee is indeed a concern. But I think as long as there is a market for PV and fuel, and there is an auction process for liquid fuel in exchange for P fuel, the arbitrageurs can calculate the gas fees themselves. So what they need to do is that they activate like the auction, for example, like bidding method, and they need to pay a gas fee. But given like right now, I think the Filecoin gas fee is like reasonable. Yeah, we can also do like a timed auction, which means that, okay, we do this every day, right? We aggregate all the received fuel from like previous day, and then we do it like, say, UTC at midnight or at noon. That could also be a case for us to reduce the gas fee.
So bootstrapping is what's the bit for the market?
What's what?
Bootstrapping it, getting up there and creating a market.
Uh-huh.
Market makers through that. It's like, there's obviously like we see this as like the demand storage provider.
Yep. Do you mean like who will be the investors?
Yeah.
So first of all, like all the Filecoin token holders, right? Because right now I think this provides an alternative for them to consider because you don't need to choose your miner, right? You don't need to choose your DeFi protocol. It is like a standardized that's backed by Filecoin crypto economics, and then you can earn a yield. And then also this is very scalable. Like any storage provider can just take their 1 million initial pledge and then mint 1 million P fuel. And then they can, slowly sell it, or they can just like, mint P fuel as needed. They don't have to mint everything all at once, right? They can just mint, say, I need like 200 P fuel, I'll just mint it. Which yield?
Also, just a reminder that we have to
Okay.
we have time for a couple more questions, but
Yeah, so, but just quickly, where does the yield come from? The yield come from the price difference of minting P fuel at 1 to 1 and buying back at below 1 to 1. It's like I'm selling you P fuel at 1 to 1 for your future cash flow, and then in the future I'm buying back at below 1 to 1, and the yield is the price difference.
So is that how's that set?
What?
Is it set
It's set by the market, but the market was likely have an equilibrium, as I characterized by this equation. Yeah, but yeah, I think we've talked about this. Like you can do liquidity management, mining booster, yield earning, and trading opportunities. But feel free to reach out to me. I think the protocol is agnostic to that. You can have a DEX, you can have a market maker, you can have a listed on centralized exchange. But yes, likely like there will need to be a DEX because for this protocol, this protocol does not require a DEX, right? Because the exchange process happens in the auction format. Sorry about it. For good. This is permissionless. Everything is permissionless.